Hello and a good morning from New York. My name is Bart van Ark and I'm Chief Economist at the Conference Board, and welcome to our monthly virtual panel, which this month will be Window on China's Economy, which obviously is one of the hot topics that we always address every month in our virtual panels. I think the last one we had on China is about a year ago, so it's about time for us to address the China issues again, given everything that is going on. So we're going to talk about what is happening to China. Is China perhaps holding up better than we think, or is it even at risk of weaker growth, or is it perhaps right out in free fall? And for that we've got a great panel together, which I will introduce to you in a minute. But before we do that, I'm going to first suggest to you a few things that you can benefit from during this webcast. One thing that's very important, because this is a panel, so we want to hear from you, and you can do that by putting in your questions, and that these questions you can put into a chat box which is at the bottom left of your screen. We will then weave those questions into the conversation that will get on the screen here. So please do so at any time. Whatever your question about China's economy is going to be, or business, just put them here and we'll find a time to make good use of them. We don't have really a lot of slides today, but if you nevertheless want to download the slides with the information about our panelists, then please do so by clicking the file download button. You can view the video full screen, particularly if we don't have a lot of slides. You may as well watch us talking to each other. And again, you can do that by clicking the 4 arrows at the top right of the screen. We always like to hear from you, so at the end of the conversation this hour, there's a brief evaluation. Please take a minute to do that. It really helps us to continue to improve the experience that you get with our webcast and panel discussions. And then, of course, you can always share this conversation with your colleagues in your organization. That you can simply do by downloading the webcast. It will be on our website shortly after this webcast, and then please do so, as we always like to find a way for you to spread the news. And then finally, some of you may be eligible for credits, and we do have credits today, CPE credits from NESBA. If you are eligible to that, then type in your full name and email address in the space provided. Click OK for the free pop-ups that appear during the webcast. Stay online for the entire webcast, and of course the credit is only available when you are actively participating, well, not actively, but at least participating live in this webcast. And of course we'd like you to be active as well. Okay, with that as introductions, let's go straight away to introducing some of the topics that we want to talk about today. As I mentioned, there's a lot of discussion now about where China's economy exactly is going to be. Industrial production, we know, has been declining very rapidly globally, but perhaps some of the origins are that actually situated in China. We have the trade disputes raging on. We have this whole bigger issue about globalization retreating. And it feels as if China sometimes is in the eye of the storm. Although China's economy is weakening, at least the official measures that we're looking at are holding up reasonably well, but at the same time there's this feeling about anyone sort of engaged on China, operating there or doing business with China, that there are really some underlying serious structural problems happening in China. We just don't quite understand always how big they are, and that's why we've got this excellent panel together today. So what we're going to do in this webcast, before I introduce our panelists, is we're first going to talk a bit about the current state of China's economy, what is going on in the manufacturing sector. Is this transition from an export investment driven economy to a consumer services driven economy, is it really happening, and how is that taking place? What is happening in the labor market? And then the second part of the webcast, we're going to focus on policy. What government policies are in place, and do they work, or is it just talk? And what policies we might actually be seeing more important in going forward in 2020. And then finally, we'll take some time in this webcast to take a somewhat longer term perspective and see where is China really heading? What is the potential for growth? Are the best time over, or are these great programs that China's been announcing over and over again, whether it's Manufacturing 2025 or the Belt and Road Initiative or whatever, are these initiatives really going to pay off in terms of more sustained growth in going forward? Okay, so now is my time to introduce the panel, and we have a fantastic panel. At least 3 of our panelists have a huge experience in China. If I add up the years together, they're probably getting close to about 75 years of experience in China, because all of them have about a quarter of a century of experience with China, which is fantastic. So first of all, we'll have Stevenson Yang. She's the co-founder and research director of J Capital Research, which was founded in 2007. Formerly, she was working for an online media business called Blue Bamboo Ventures. She has over 25 years, as I said, of experience in China, worked as an industry analyst and trade advocate, among other things, with the US-China Business Council, and also has a book which she wrote in 2013 with the interesting title, China Alone, China's Emergence and Potential Return to Isolation. So we will definitely talk a little bit about that. And thank you for joining us, and thank you for taking the time out of your busy schedule.
Thank you.
Great. And then on the left-hand side for you, as audience of Anne, is Leland Miller. Leland is the CEO of China Beige Book. He's a leading authority on China's economy and its financial system. Works very closely in his capacity with chief investment officers and corporate boards to really assess long-term risks with regard to China, as well as has a proprietary forecasting platform. You can see Leland very frequently in the media. He's frequently featured on Bloomberg Radio and TV, CNN, the BBC and Fox Business, and again has a long-standing experience on a variety of issues in China. Was also a capital markets attorney based out of New York and Hong Kong. So Leland, again, a lot of experience and brain power in the room. Thank you for joining us today.
Happy to be here.
And then on the left of that is my colleague Atwan Ozyederim. Atwan and I do not have as much experience in China as our other audiences have, but Atwan and I are heavily involved in the conference board's annual and quarterly forecast around China's economy. We deeply engage with our China Center colleagues who are based in Beijing, and we'll together hope to give you a little bit more flavor on how the conference board is looking at the China issues. Thanks for joining us, Adaman.
Good morning, Bart.
And then finally, last but not least, we're going to the only person today who is virtually joining us, but very important, Leo Austin. He's the advisor to the China Center on Economics and Business at the Conference Board, which I already just mentioned. And he has 22 years of experience in China. He's actually one of the few foreigners who actually has run a large Chinese-owned corporation. That's something that deserves special mention. But has also done more than a dozen of major China investment and restructuring transactions. He's joining us today out of the UK. Thank you for joining us, and again, taking some time out of your busy schedule, Leo. Great. Very good. So let's get going then. And as always, before we sort of go into the detail, we always like a little bit to test the temperature in the room, and we can do that with poll questions. And the first poll question my colleagues are going to put up for you right now. And that poll question is, in your opinion, which of the following statements is most true? Right? So just pick one that you think is most true. The economic growth slowdown in China is likely to intensify in 2020, mainly due because of domestic challenges. The problems are likely to intensify because of the China-US trade dispute. The economic problems are really the main cause of the global recession in 2020 that we may see. The economic slowdown will probably reach its low point by the end of 2019 and begin to improve somewhat in 2020. The economic slowdown is not worrisome because it's just a natural consequence of the vast progress the economy has already made. Or none of these statements are true. If that's true, then if you have the last one, then please put into the chat box what you think our statement is true, because we'd like them to hear what we were missing here. So let's give it this somewhat complex, so we give you a little bit more time to think about it, and then I'm going to count down. We close the poll, and then I'm going to ask each of my panelists for a very brief response to what you're seeing here. So 5, 4, 3, 2, 1. And then we're going to close it down. So it's about 50-50 distribution between the first two. It's going to get worse in 2020, but it's either because of domestic challenges, and the other quarter is saying, no, it's really because of these trade disputes that we're seeing with the United States. And then the other opinions are a little bit spread around the other three. This could actually be really bad and causing the main cause of the global recession. It could actually begin to improve a little bit, or it's actually not worrisome because this is what happens if an economy does very well for a long time. And 30 seconds, your first response. Surprised?
I'm not surprised. I think I'd go with number one overall. I think that it's a consequence of it's the natural decline of the investment-driven model.
Leland?
I agree with Anne. I don't think the U.S.-China trade war is going to intensify in 2020, but even if it does, this is a problem for China on the margins for the most part. With the problem right now is that they have an economic model that's slowing down, and they're trying to reckon with how to admit it's slowing down and how to restructure it without upsetting the landscape.
I'll come back to you in a second because we're going to go right into, but let's start with Leo. Leo, what's your first response here?
My first response is the domestic issues are so much bigger and more important than the export issues that I'm completely on board with my colleagues. But I would say that it's the last couple of quarters that people have seen, the stock going through the channel, the pre-tariff stock sort of feeding its way out of the system. And I think that shock's beginning to hit people right now. So regardless that things might not get worse in trade terms, I think the bad news is beginning to be felt right now.
Okay, now Atma, let me end with you, but perhaps immediately get into sort of the conference board view on this, right? Which one would we have picked at the conference board, and how does that feed into the outlook which we actually produced for the global economy last week, and in which China, of course, features very prominently?
Well, I'm a little bit surprised that the trade disputes are getting as much in the polls, because I think we're putting a little bit less emphasis on that, especially for next year. We don't think that it's going to keep escalating further, but we are seeing a lot of news, and that news is being reflected in what folks are thinking about it. So I think it's kind of creating a little bit of noise in interpreting what's going on. But in terms of the next year, we're actually thinking that the Chinese economy might even pick up slightly.
And that is mainly because of industrial production, right? Because industrial production has come down so much. So why do we at the conference board believe that we might actually begin to see the end of that?
So, partly with the sort of pullback from the trade disputes, creating a more favorable environment, and partly because of the Chinese government helping out some of the industries, but not to the same extent that we've seen before in these large stimulus programs. So that creates a little bit more favorable environment. But also we do project the global economy to recover a little bit too. So that's also going to support the Chinese economy.
Yeah, and perhaps even the industrial production decline. And Leland, let me go to you here. One of our views is that what basically happened is that maybe unintentionally, the Chinese government has actually stopped putting so much money in creating even more excessive overcapacity that was already there. So there's a little bit of a silver lining that maybe some of this excessive overcapacity is gradually going away, which means that everything that's left becomes, a little bit more productive. Are we too optimistic to see that that might give us this silver lining in 2020?
Well, I think you're a little bit optimistic on certain things. If you take us back to 2016, 2017, 2018, what we saw was not a story. You have a very strong Chinese economy overall, but if you look at the headlines, it was consumption taking over investment or services taking over manufacturing. That is absolutely not what we saw in our data. What we saw was an enormous run, 10 straight quarters, where manufacturing continued to outperform. So the strength of the economy into the Party Congress even afterwards was overwhelmingly because the old economy stayed strong, not because the new economy was evolving to take the leadership. So one thing you're seeing is just sort of a natural slowdown of the manufacturing sector because it's been overheating for a long time. The bigger question people should be asking themselves is why didn't it happen sooner? And if you look at our credit data, so we collect credit data from thousands of firms, and it was very clear that there has been enormous policy support into the manufacturing sector beyond any other sector, particularly in 2019. So some of this is going to just keeping these firms afloat, just keeping them continuing to produce. So we actually think that had there not been this overwhelming amount of policy support, most of which the government doesn't admit to at any given time, then you actually would have seen this slowdown much earlier, and you would have probably seen it much more dramatic.
Right, but now that the slowdown has happened, my point would be, just challenging you a little bit on this, my point would be, okay, finally we're going to make this change, and finally we're going to open up a little bit more for new firms and for new economic activity that might very well be more productive and more favorable. Are you saying that's just much further down the line, we're not there yet, or are you saying that now that the economy is actually slowing so much, maybe the government is actually going back to their old style kind of stimulus, and therefore we'll have to wait for that to happen?
Well, you always have the possibility that they're going to go back to their old tricks, because what the Chinese have done for years and years is take 2 steps forward and then take 2 steps back. So we don't know. But what I think we're going to see regardless is somewhat of a bifurcation in manufacturing going forward. So there are going to be chosen industries, particularly the ones that are part of advanced manufacturing, that are going to continue to get support, and they're going to continue to be champions. The hope since that's going to happen, is that the rest of manufacturing will be treated differently, and that there will be a different treatment of lower value manufacturing, and you'll actually see them dealing with overcapacity within the system. It's not going to happen with the entire manufacturing sector, but you could very well see it happen for large parts of it.
Leo, let me go to you. I want to talk a little bit not just about manufacturing, but also about the consumer, because obviously that's critical. And the Chinese government's idea was always be that there has to be rebalancing of the economy, and the consumer has to become more important. So in a way, this slowdown in the manufacturing sector is welcome. The question is, how is the consumer doing, and is the consumer really picking up the slack? And it doesn't look like it, right?
Well, if you look at the confidence data, it looks wonderful. It looks like Chinese consumers are very confident. If you look behind that data, there's a lot of indication that's primarily driven by people who were born after 1989 and have never seen a real slowdown in the Chinese economy. So you might say there's a little bit of irrational confidence, particularly people under the age of 30. When you want to divide down, sort of bite down into the pieces underneath that, you look at jobs, you look at property, and you look at debt. And on those three issues, it's a very different picture. Jobs, look at all of the PMI data. It doesn't matter if it's Caixin looking at the small companies or if it's NBS looking at big companies. It's not a good picture. The only bright spot is small company services, which is actually growing. If you look at property, the costs of property are very high all over the country, but there are a small pocket, I would say, of comfortable cities, particularly west of Shanghai, places like Shaoxing that have high incomes and low property costs. And if you look at debt, as was being discussed a moment ago, we had a huge debt boom really in the sort of 2016, 17, 18. And what's happened now is the debt service has really come up in the wake of that. So we're at a debt service ratio of around 10%, which is just south of where the US was in 2007. It's a big increase. Overall, we see a really squeezed middle class right now. We've seen middle class income growth falling consistently for 3 years. We see a still very aggressive luxury business owner element at the very top. They've got wealth they're working their way through. And we see at the lower level blue-collar workers who are very conservative and they're not buying right now. And if you look at the average, the mass car segment, 100,000 RMB or about $15,000, it's not moving because people aren't buying because they're worried about jobs.
So why then do consumers remain so confident? As you mentioned earlier, we do consumer confidence around the world, including China. It's come down a little bit in the last quarter, but it's really still historically high. Is it just the nature of the Chinese, and even if things are bad, they remain confident, or what's going on?
Well, it's really interesting if you dig behind the data and do some surveys and you divide really into the generational segments. Over the last year, the eldest people in the Chinese household, and traditionally a lot of Chinese households have had 3 generations, grandchildren, children, and grandparents. Over the last year, the grandparents have become universally negative about what's going on, and they've begun to tell the parents in the household to be very careful on spending. And we can see the parents turning down a little bit as well. But under the 30-year-old, sort of split, they're fantastically confident. And I think it reflects both the nature of China and emerging markets over the last 20 years, but it also reflects the incredible success of propaganda in China, and the fact that they've really won the war for belief right now.
So, Anne, industrial production down, consumer not doing great. What else are we missing in this story here that explains this sort of problems that we're seeing in China?
I guess I'd like to echo and amplify Leo's comments, which are very interesting. But I think the key issue that's missed on the Chinese consumer is the degree to which he's driven by investment. So how many? Leo mentioned Shaoxing incomes, and there are certain pockets where incomes. I mean, really, I don't think you find anywhere in China where incomes are commensurate with property levels. What is commensurate is investment gains. So it may be from flipping property, it may be from selling land, it may be from the stock market, it may be from getting investment in your private company, whatever it may be. So the capital flows are the key things to watch when it comes even to the Chinese consumer.
Let's do a little...
Actually, Anne, may I dive in there a second?
Yeah, sure.
Just very briefly, that's not entirely matched by the experience of our consumers. I 100% buy the point that property drives everything and that wealth has driven a huge amount of consumption in China, followed on by debt over the last 2 or 3 years. But if you look at the multinationals in China, they are seeing real growth in everyday grocery consumption, in standard, everyday premium in a certain group of cities. And if you look at them, there are cities where incomes are remarkably high, 60-70% of Shanghai's levels, and the property burden is 20%. So there are places that have income and are actually consuming out of income. It's worth looking again at those.
Oh, absolutely. But what I'm talking about is consumer durables. So how many people actually have incomes that would afford a $30,000 or $50,000 car? Not that many. Many more SUVs are sold than are commensurate with the levels of income in China. Same with property. This is not the same thing as talking about selling candy bars or baijiu.
Ataman.
So when it comes to consumers, there's one thing that I've been trying to get a handle on better is this idea of the savings rate being very high, partly because the social safety net is not as well developed. So you have to kind of keep savings for health, for retirement, although they rely on their family members too. But what is your sense, I guess, to the panel of what level of savings is doing to the level of consumption? So are they really geared towards saving and holding back from consumption?
Well, I think that that's a slightly outdated view. I think that if you look at surveys of wealth by household, you'll find that 50% of households in China have really no savings when it comes to cash and accounts, and the principal saving levels is corporations. You do have high-income households that have high levels of savings, but it isn't any more true, as it was 30 years ago, that Chinese households are saving 40% of their income for the future.
Lin, any thoughts about that, savings?
Look, I mean, one of the major problems you've had in China is the fact that you don't have this social savings net.
Right.
So this is an issue for people with their thinking about spending. The demography of China, the demographics of China is changing dramatically, and so people have to be thinking about how they're going to be able to afford to take care of their parents and up the chain in terms of one child being taking care of two parents and four grandparents. So all these things are part of the formula that worry Chinese consumers.
So let's do, before we move on to the policy discussion, let's do a little comparison of numbers just for the fun of it. What is your estimate of GDP growth in China? What your true estimate of GDP growth in China in 1919 and 2020? And let me start with you.
Well, it depends on what you mean by true.
What you think is true.
I find it useful to separate the manufactured GDP growth. I don't really have a complaint with the 6% or. I have some complaint, but not a big complaint. What I think is important is what is real underlying organic GDP growth as opposed to what's created by spending money to dig a hole and fill it back in. And I would put that south of 2%.
South of 2%.
Well, I think Anne has the right framework for this. I mean, you have a GDP number, and then you have a GDP number that would operate without misallocation of resources, which is a totally different number. Since we are forced to constantly play the GDP game, because it's what a lot of people care about, we're putting GDP numbers. We think that back in fourth quarter, where our data were much worse than what was coming out from the official data, we think the GDP number was about 2%. But there was a recovery in the first quarter, and we think the second quarter was actually stable from the first quarter, not a downturn. So because China doesn't recognize the downturns, they don't usually recognize the recovery. So what we're seeing is significant volatility in this number that drops down to 1 or 2% during very difficult times and may shoot back up. I wouldn't be surprised if in the high time in 2017, when things were going gangbusters before the Party Congress, we saw 10% growth. But I think that story is lost because all the Chinese want to do is just smooth this number.
Move it over time, over and over. Ataman, what's the Conference Board estimate of GDP growth in China?
So we've done a lot of work to try to come up with some independent estimates for China because of all the issues with the official numbers. And so for 2019, we land at about 3% growth. But that's really coming down pretty sharply from 2016, 2017 on, from over 4% to 3.7 to 3%. And a lot of the same issues are being reflected on that. So, the range of estimates really vary from, like you said, 2% all the way up to the official number, 6% or above. And we're somewhere, a little bit below the middle there, around 3%.
And for 2020?
For 2020, slight improvement, like I said earlier, it's about maybe 3.4% if everything goes well.
Yeah. Leo, anything to add to that, to these estimates? Where do you find yourself?
I think I think what we're looking for, as Anne said, is sustainable long-term natural growth. If you went around the local governments 6-9 months ago, you found nothing was happening. No one had any money, so there was very little filling in holes. That money's coming back, but hardly at all right now. So I mean, if you overall said the economy grew last year around 3%, that's pretty much the natural level of growth without any of the false, concrete filling.
Okay, good. So let's move on. So a little bit lower than the official estimates for sure, and definitely less smooth. I think that point is very important to pick up. So let's move on to the policy side. But I want to take a little bit of an intermission here and very briefly talk about the trade policy dispute. There's a lot out there, so we don't have to spend a lot of time on it. But I particularly want to hear from you guys about the China response to the policy trade dispute. What's China's next move, and how will that play into 2020? And may I start with you again?
I'm kind of a micro person. What I see is petty. The Chinese statistical services are not providing data to a lot of the U.S. platforms that they have contracts with. Everybody is finding it hard to accomplish things, whether it's even change registration or get dividends reported out of China. And this instability. I think that the Chinese policy nexus underestimates the importance of instability and unpredictability in corporate decisions.
Leland, what's the next move for China?
Well, I think what China would like to do is get a stalemate through the 2020 election where things just don't get worse for them. And that means two different things. One, the tariffs don't blow out to $550 billion, which would cause real pain. Now, it would cause pain on the U.S. side, too. But this, the first tranche they were able to counteract through currency depreciation and through backdoor subsidies. The second caused some pain. The third would cause a lot more pain. But the reason that China continues to stay at the table, the trade table, despite the fact that nobody's happy that Donald Trump is being erratic or humiliating the Chinese side at times, is that this could get much, much worse for China if they don't keep one foot in the doorway, because it's not just about trade. If President Trump likes to hold back some of the congressionals who would like to have a much tougher China policy, if he were to say trade talks are off, the Chinese are being unreasonable, go get them, you'd see a ramped up response on Taiwan, on South China Sea. You'd have some more Chinese tech companies that were sanctioned. You would have all kinds of responses around all of China policy. And so I think the Chinese goal is to just get it at a sustainable tariff level and just see what happens in 2020.
Right, and Antoine, is that not a little bit aligned with the Trump administration's interest as well? I mean, even though the president may send out an occasional tweet and it could still escalate, but probably it makes most sense from a U.S. administration perspective also to not let this thing further escalate running into the 2020 election campaign.
Yeah, I think the stalemate outcome might be sort of the most realistic one to expect, especially as we go into the election cycle. We've seen them kind of announcing tariffs but holding them back until after the holiday season. So there's definitely the political considerations. But I do think that it is a long-running sort of dispute between the U.S. and China, because it's really much more about the deficits bilaterally, but there are deeper issues.
Just one thing to add here, and I know you said don't talk about the U.S. side, but I just want to say a quick word, because I think that all of this is correct. The U.S. side is looking to ramp things down, and what's different now than there was a few months ago is that some of the hawks that were sitting on the president's shoulder on trade have now become doves. So you don't just have people like Treasury Secretary Mnuchin and Larry Kudlow and others who are telling him to ramp down the tariffs. You have people like Lighthizer who think that it's a much more sustainable way forward to pull back December. If you can get some trade-offs, maybe even pull back September, get these things down to 250 billion tariffs, and that's the most sustainable path through the election. So there's a weird dynamic right now that occurred in August that is pushing the president to be more dovish on trade that was not at play several months ago.
Leo, let's assume that it's, and I guess Leland's assumption is correct. We all want to push ourselves, through this 2020 election in the U.S. But then the question is, we're back to the table, and what is then, China's next bid, on the table? Because we haven't dealt with these issues like technology transfers and IP and everything else. What's China going to do?
Well, their process has always been first control, then mitigate, then divide and rule. So control is all about the short-term political issue. They've won the narrative within China. I don't think the people in China are blaming the trade war right now on the Communist Party. Mitigation is about what they're doing right now. Spend as much money as necessary to keep this in check and don't allow it to get any worse, just as Leland said. And then divide and rule, which is about their long-term aims. Right now, they're still working pretty hard on discussions with the European Commission. And what they're thinking about is the long-term elephant in the room, which is really demographic change. They're going to lose close to 10% of their working population over the next 10 years. They have to automate. They have to move up the value chain. So they are very concerned about getting cut out of global supply chains and global financing. And they're going to do everything they can to ensure they win that long-term game, regardless, I think, of the short or even midterm pain.
Right. So let's now broaden the picture a little bit, and we'd like to ask the audience a next question to really think about what sort of policy areas are really going to be important now to get economic growth in China back on track. And if my colleagues can put up the poll question, you've got a lot of options here. The question is going to be the most important policy instruments that China will use to support economic development and stability are. And you can just pick one. So pick the most important one. Of this whole list. Is infrastructure spending going to be the critical factor? Is it business and personal tax cuts? Is it management of government debt and including the debt of local and provinces, real estate management, easy lending rates, mitigate liquidity risk, control excessive capacity, reduce shadow banking, pretty big deal in China too, pollution control, targeted industrial policy, or anything else that we're missing on this list? And then if that's the case, please add it to the chat box. So we'd like to hear from you what else you're going to put on. I'll leave it on a little bit because lots of options here, lots of policies here. Some work, some don't. And then I'm going to ask the panel members very quickly again, which one would you pick? What are you surprised about? And we'll give it a little bit more time for people to think this over. What is the most important policy instrument that China will use to support economic growth, development, and stability in going forward? And we give it 5 more seconds. 5, 4, 3, 2, take your pick, 1, and now we're going to close it down. Okay, 1/3 are saying infrastructure policy. That's the most important pick, and then it's pretty much spread around. 13%, 13% of you are saying control excessive overcapacity policies are going to be critical. Then a little bit further down is targeted industrial policy. And then a little further down is tax cuts, business and personal, and everything else. Oh, I missed the third one. Very important, actually. That's 20%. That's management of government debt. So first is infrastructure spending. Second is management of debt, and then third is control of excessive overcapacity. Quick reaction, Leo. Let me start with you this time. First, quick 30 seconds. We'll come back to you in a second, also.
Okay, none of the above. Actually, I think that there are very, very few things that can move the needle in China. I think urbanization and internal migration is the easiest one for the government, and I've heard a lot of noise about that in the last 3 months. Then the second issue is that all they have to do is actually encourage the private sector, deregulate, and allow them to get on with their job, and China will be fine. They're not really looking to do that right now. They will have to eventually.
Okay, great. We'll come back to you on that because we'd like you to comment a little bit more on those 2 points. Leland, first comment. Surprised?
So I will disagree with the majority, but only insofar as infrastructure spending will not return to what they've been doing before. Of course, it'll continue to be a crutch for the government on some level. I think that they're very intent on not having it go back to 2016, 2017 levels, and that connects to reduce shadow banking. I mean, I'm glad only such a small percentage thought reduction in shadow banking. One thing that we're seeing in our data right now that just jumps off the screen is that shadow banking you don't see a shadow banking resurgence in government credit data yet, but what we're seeing in our data right now is the largest jump in shadow banking usage by firms in the history of China Beige Book survey, data going back almost a decade. So what we're seeing right now is less reliance on credit going into big infrastructure, 2016 style, but we're seeing a lot more credit provision, most of which the government has admitted to, and most of which is now coming through a shadow banking channel as well as bond sales. So the mix has changed, but the credit provision is there.
And
yeah, exactly. I call that the Heisenberg principle of China data, where as soon as you can see something, then it disappears or it changes its nature. So the government has targeted shadow banking to reduce, and therefore the shadow banking has gone into alternative channels, principally what they call private equity, but isn't really. So as for the poll, I think the ambivalence we see in the poll is around the question of, the most important policy instrument. Does that mean what the government can do and will do, or what they should do? So what they can and will do is a little bit of each. They will reduce, they will try to reduce local government debt, and they'll try to increase infrastructure spending, and they'll keep everything sort of flattish. What they should do is say to the whole real estate sector, if you can't pay, you're out of business. That would create a huge disaster in the economy, but it would create a healthier economy.
That's a really good distinction. It was really mentioned to be the first one, but the second point, what I should do, who knows, they're listening. Ataman.
Yeah, it sounds like the audience is very familiar with the playbook that China uses in managing the economy through administrative controls. And they would really have to surprise us by some kind of policy measures to not fall back to that.
Right.
So I'm not too surprised.
So let's take a little bit more a deep dive, Leland, into this debt issue, because obviously it's nothing new, right? This has been going on for a while. So I think what the main puzzling thing to me is, and I guess for lots of audience, why has it got so much worse, and how much worse can it still get? Because I remember these discussions with colleagues of yours, 5 years ago, and say, well, we reached the tax, this thing is going to collapse, and it hasn't so far. So what is making it so much worse, and what's making you worry now more than you were, say, 2-3 years ago?
Well, if you look at official credit data, what you see is a relatively reduced amount of credit from past years, and you see M1 slowing down. It's led everyone to believe, wow, the Chinese are really, they're leveraging, or they're being more responsible with credit. That's not what's happening. What's happening is that they're not pumping it into big infrastructure. At least they're not doing that yet. But what we're seeing right now is highs in firm borrowing. This past quarter was a 6-year high in the share of firms reporting borrowing to us. So this isn't hundreds of firms. This is over 10,000 firms in 2019 that we got this data from. So we've got highs in firm borrowing. We've got highs in bond sales. We've got a return of shadow banking, the last 2 quarters in particular. And within the credit data, it's not just more firms borrowing. We saw typically disadvantaged firms starting at the beginning of this year get lots more access to credit. So you had SMEs start borrowing a lot more. You had private firms borrowing a lot more. Loan applications going up, rejection rates going down. And what does this mean? It means that the government's stepping in and telling banks, we do not care about the credit risk here. You will keep these firms afloat. And it's one of the reasons you've seen M1 slow down so dramatically. Yeah, they're not creating growth. They're using this credit to stay afloat. And it's a very dangerous position to be, considering how much credit has ramped up even from 2018 to 2019.
So what are they doing to try to begin to tackle this? Because they will be aware of this, that this is running out of hand.
Well, I think the first thing they've done is say, we're not going to pull the infrastructure lever just yet, and this is going to be our dessert for now. And then I think what they'd like to do is say, trade war's not going to get less, and we're going to accept lower growth, and we're going to try to sort of nip away at this. And what we're going to do is allow this provision of credit that we're slowly going to admit is happening, but not immediately. We'll probably have another 6 months before we start hearing that shadow banking actually did come back. And they're going to allow that to cushion the economy. And in a beautiful, optimistic scenario where the trade war doesn't ramp up in 2020 and conditions don't get materially worse, they'll accept slower growth because they can blame it on Trump, they can blame it on a global recession, they can blame it on a global manufacturing or trading conditions. And so they'll want to use that credit. It's not going away, but they'll use it to cushion the economy as they slow down. Now that's the optimistic take.
So, and when you look at your customers from their perspective, you already mentioned what should be done. What is their biggest concern right now that will determine their investment decisions for the next year or two, from a policy perspective?
Well, I really look at portfolio flows, and portfolio flows are completely agnostic as to policy. All they look at is sort of the price of the dollar, the price of debt, the price of equities, and they are most definitively flowing away from China, as they have been for quite a while. I think for corporates, their big concern is the transparency of the environment. Of course, everybody likes it when they pour in stimulus as they did in 2016 because it brings up, floats all boats. But what really is bothering companies is the lack of clarity on their ability to export tariff-free or get certain licenses or whatever that might be. So you do see a cautious rebalancing of the value chain away from China.
Leo, let me go to you, and I want to take the opportunity to actually take 2 of the questions of the audience and put them to you, and hopefully you can help us answering this. So one question here is, there's nothing in that list on liberalizing the economy and any policy intention to allow more economic market freedom. So maybe you can respond to that. And then the other question actually goes back a little bit to comments you made earlier, which I'm posing it to you, that even though the economy slows down, unemployment stays stable. What is the status of China's job market? In other words, how safe is China's safety net? and how important is that safety net policy environment?
So, so let's go through. Let's take the second one first. There are a large group of consumers in China who have zero safety net. Okay, these are the value consumers, the blue collar, who ultimately, own their own house. 94% of county people own their own houses. 82% of people in the cities, but they don't have a second house, which is the vast majority of people. For these guys, I think that given the incredible growth in debt over the last 2 or 3 years, there is a very weak saving situation. They don't really have, they do have access to debt, but it's going to be limited if they've already taken out a mortgage. So I would be very conservative on how big the safety net is in China right now. I'd be pretty careful. I think you'll find a lot of people going very conservative very quickly. And I think over the last year we've seen that. We look at quarter by quarter the growth in new savings in the economy. And if you look at the increase in savings over the last 2 quarters, it's incredible. We've had a 60% increase in new savings in quarter 2 of this year. And that really is A, about people preparing to repay debt, and then it's B, about them getting worried that there's actually maybe not enough money for the next couple of years. So I think the savings issue is pretty important. Can you run past the first question?
Yeah, sorry about that. Yeah, the first question about what about liberalization measures? Is there just no thinking about allowing more economic market freedom as one way to begin to revive growth?
It's such an interesting question because there are so few measures which can move the needle for China. Anne very correctly said all of the above could happen, but none of them are important enough to make a difference. So they are going to have to liberalize. Over the last 2 or 3 years, any private sector entrepreneur in China has been depressed. He has said the whole signal is that I'm no longer welcome. It is true that from the state sector, as of pretty much quarter 3 last year, when President Xi met the heads of Tencent and Baidu and so on, he told the banking sector to lend to private companies. But if you look at the Moody's data, they're only lending 10 million RMB on average to all of these companies. It's not even enough to manage their working capital. So if they turned around and said, make a real impact through the official channels on private sector borrowing, he went to all of the local officials and said, listen, you need to favor private sector companies in your developments, it would change China and it would unleash incredible needle-moving forces. There's no sign of this happening.
So let me ask this to the panel here in the studio. Indeed, there's not much of a sign of liberalization of the economy. Is it unavoidable for China ultimately having to do that? And
the huge contradiction and problem with liberalization is that it would undermine the power of the Communist Party. So will it be done proactively? Absolutely not. Should it be done, and would it save the economy? Yes, so one has hope that will happen. And I agree with Leo's original point, which is that the huge game-changing gesture would be to eliminate the hukou system. But that would be, it's not a matter of just allowing people to live some other place. It's a matter of changing the whole educational structure, health provision structure, as well as housing. And so I'm not holding my breath for it to happen.
Yeah, I agree with that take as well. Look, you're not seeing liberalization, you're seeing the opposite right now. You're seeing a centralization campaign across just about every aspect of the Chinese landscape. And so will we see liberalization in some future where China has slowed down growth, they've gone through their dislocations, they come out the other side, and then you have a stronger, healthier Chinese economy become something different? Absolutely. I mean, that's the path forward for China if you're looking forward to 20 to 50 years. But the party's never going to let that happen in the short term. They would lose control. So we're going to see the opposite happen, and we're going to see stagnation and possibly worse because of that if they're not careful.
So let's move into the last section of the webcast. And we're already moving there a little with this discussion in the last minute or so, which is about sort of the longer term and liberalization. But if you really look at China's growth potential and being a good environment for investment, I think the real question that I would have, China's not going to go away. It's a very important economy. It will continue to grow for most of the time. The question is, will it be just one of many economies, or will it still become a sort of world leader? And can it still be a world leader in the 2020s? So, Leo, let me start with you, and indeed now talk a little bit more about the longer term strategic initiatives that China would undertake. So there's all these huge programs that I referred to earlier, Manufacturing 2025 and One Belt, One Road, and well, you name it, there are many, many more. How much of this is really going to help to get China coming back as a global world leader in the global economy?
Well, listen, China's still going to be an incredibly large economy, and that's going to drive fantastic economies of scale for every producer. So for any manufactured good, don't expect anyone in the world to make it cheaper than China for the next couple of decades. So I don't see any problem with them remaining a leader across a whole host of sectors. I think that in the medium term, I personally don't see, the Belt and Road agenda moving the needle in any way at all. I see Made in China 2025 as a necessity as they struggle with a demographic revolution over the next few years. Generally speaking, you still have to recognize that the willingness to get stuff done in China, even if it means skirting around regulation, the speed of activity and the willingness to innovate is world class. So I have a lot of confidence in the Chinese people. What I don't have confidence in is indigenous innovation in core science. So if you're looking at some of the sectors in Made in China 2025, where they have to go back and they actually have to research from first principles, if you look at the rate of return on intangible investment in China over the last 30 years, it's been terrible. Where they've made real success has been innovation in business models and where speed and flexibility can win. If you're going to tell them to go back and reinvent semiconductor chips, they're probably going to be behind the curve for a very, very long time on this.
But the question is whether these indigenous innovation programs are really needed in order to, improve business processes and management structures and everything else in China. So wouldn't this naturally happen as companies are going to advance and therefore get more sophisticated management and things like that?
No, I don't think when you come to changing in the core model of processing in China, which is the lack of labor. There is no one coming into the economy right now, and they're going to be leaving the working population for years to come. The government has to lead that process. They're going out right now and building clusters on automation, on robotics, on new energy, which ultimately are hoping to build sustainable businesses that don't require labor. I mean, that's really what's scaring them, and the government does have to lead that. And I would say they are.
And you mentioned that money is flowing out of Canada. What will make money flow back in?
Out of China? A proper legal structure. So I would say eyes on Hong Kong and see what happens there. One hopes that they will get through this crisis and become more transparent, more democratic, and more vigorous. It's kind of 50-50 now, but we'll see. And I think that could be a model for what happens to China. But I think we've all been saying, and Bart, you need to find people who disagree with each other next time. But I think what we've all been saying is that government intervention is not helping; it's counterproductive. And so hands-off would be the better policy. We're not seeing that that's happening at all.
Leo briefly alluded to that. These industrial clusters, which is obviously very much an important focus of Manufacturing 2025, which ones do you think are going to ultimately make it, and which ones do you think are going to be a failure?
Well, the Chinese give you the playbook. I mean, they created Made in China 2025 because that's where they're going to be putting their resources.
Yeah. But does that mean they will succeed?
Well, it depends what succeed means. If it means compete on a global level with the U.S. on all these things and beat them in some of it, I think the answer is yes. Now, that doesn't mean this is a very big difference between an innovation economy and having basically a program that focuses on a handful of things and puts all the resources and all the focus in it and gets them done. So, for instance, if the Chinese want to be world leaders in AI and quantum computing and robotics and a handful of other things, they have some advantages over the Western systems. They're able to focus in, they're able to push through red tape, they're able to force coordination in a way that the U.S. system is not very good at doing. On a broad level, I think the Western system will beat the Chinese model 95, 99% of the time. But if the Chinese pick a few winners that they want, they're going to be very hard to compete with.
Which ones would you put your money on?
AI is a big issue in 5G. The number one issue going forward for the U.S.-China relationship is 5G. not just because of it's the technological implications, but because of the geopolitical implications. You've already seen a Chinese internet that's walled off from a rest of the world internet for the most part. 5G could be something far more difficult, in which case the world is roped off between Chinese 5G users that the U.S. and its allies will not use that 5G system, and the U.S. 5G system with Europe that's another side, or most of Europe, in which the Chinese won't use. So you're very close to a bifurcated world on 5G, and the Chinese have an advantage there. And this is something that is just now starting to get the proper policy focus.
Leo, AI and 5G are your favorites, or would you add honors?
I'm a big favorite on 5G because the number of stations is going to be a huge multiple of any other area in the world. So they're going to have the intensity of 5G stations, which we won't have at a much, much earlier stage. So on that one, I'm a big yes. AI, forgive me, that is way above my pay grade.
What about life sciences and things like that? I mean, they're putting a lot of money into that also. So why are you guys not mentioning that? What's the problem there?
I mean, I'll tell you, because there are examples abundantly over the last 20 years of the Chinese government killing innovation by focusing on it with this investment. It happened with cell phone technology, for example, where the Chinese R&D program to support Chinese enterprises created, they achieved the goal of out-exporting Nokia and Motorola, but they killed innovation in the sector. So all of the chipsets and LCD screens and software and even the form factors became the innovation became owned by Americans and Koreans and French, not by Chinese. The same thing happens with life sciences. The government chooses targets. Oh, CD1 drugs, CAR T drugs, or CD1, I want that thing. And they focus on investing in companies that will invest in that thing, and it becomes simply a way to get R&D funds short term.
One of the things that's really critical in making sure innovations are successful is maybe the most intangible of all. It's the innovation culture. And I think the jury is out in terms of whether they can get the culture of innovation right, because that's usually what leads to a successful commercialization and development and opening up markets and creating new markets in innovation. And I think it seems like China can get, maybe they have the numbers advantage, they have the economies of scale, but in terms of getting the culture right, I think that's going to take a long time.
Well, I think that's a really good comment, because forgive me if I'm trying to find some light between what you guys are all saying. Maybe there's no light. But on the one hand, you're saying, look, policy is important here, right? If you want to get 5G going, I mean, government policy is needed here. On the other hand, you're saying just a minute ago, and wherever the government touches something, it's usually going wrong when it comes to industrial policy. I think Altman is making this important point. Look, I mean, it's ultimately about culture within companies and creating a more kind of entrepreneurial, innovative kind of environment. So how much do we expect from policy in China? How much do we just expect from business people running good companies and getting better at it?
We're talking about two different things. 5G is a form of infrastructure investment, and China does that extremely well, and everybody expects them to excel in 5G. As for the culture of innovation, I have to disagree with you. As someone who's run a software and internet company in China, I agree with Leo that what China has done well is these business model innovations, and the reason it's done so well is because they're built as government regulatory avoidance structures. And that's the oppressive thing in China that you tried at Tencent, Alibaba, all of the great tech companies in China were built to avoid oppressive regulation.
Hey, Leo, you have run a China company. Do you agree with Anne that we shouldn't be so concerned about innovation culture in companies?
Well, what Anne's pointing to is ultimately, the corruption or cronyism culture by which capital is wasted. When the government says, let's do this thing, then the government gets involved, the officials get involved, the officials' cousins get involved. 5 times as much capital goes in as is necessary to do something, 90% of it is wasted. So I think the return on capital is very low. And one interesting thing on Made in China is it requires so much capital that China probably doesn't have right now, that maybe with the low return rates of kind of cronyism capital, they won't get there. That's a really interesting question. I happen to believe that the innovation culture in China is absolutely fantastic. Where it fails is at the very early stages, the kind of connection of university through science, through industrial technology, because the universities are part of the state sector. It's very slow, it's very regulated, and it's very crony capital. So it doesn't feed into anything. But if you want to go to Shenzhen today, you will find a place where thousands of entrepreneurs create entirely, new products and businesses every single day. And I think the excitement around that exists. I think the culture exists. They just have to stay away from government. And the one thing the government does, just as Anne says, is it puts capital into businesses which have to get to scale quickly. And they can get to scale more quickly than anyone in the world because they put the money there and they got the population.
We beginning to approach the top of the hour, so we will have one more poll question coming up. But before we go there, Ataman, there's one question I'd like you to pick up from the audience, and we'll take it back to the high level again when it comes to the size of China's economy and the growth rate. So we talked earlier about this sort of slow growth rate of China's economy and even slower. So the question here is, does that slow growth rate also mean that we're overstating the size of China's GDP and therefore the actual economic importance of China in the global economy?
Well, it's the growth rate is kind of, the disagreement is about the level, but I think in terms of the size, it's there. There's no other China in terms of the size of the workforce, the size of the markets. And when you look at other emerging markets, there's really not much of a comparison there too.
So some of the official measures suggest that China's economy is bigger now in terms of GDP terms than the United States. Would you agree with that?
So, it depends on how you're measuring prices and the trajectory of the growth rates. So it's probably not the number one economy. It says some ways to get there, but it's getting close.
And also, number one is not only something that's measured in terms of the size of GDP, but to the discussion we had just earlier, what's the most innovative economy and has the most potential for further growth.
Just one thing to add, that it wouldn't matter. China's GDP is not larger than the United States, but even if it was, it wouldn't matter because GDP and GDP per capita is an accounting identity.
Right.
What actually matters is household wealth.
Yeah.
And in household wealth, the numbers for China are way down there. This is a developing country. This is not a developed country.
So it's a really
different
good
ballgame.
point. Yeah. Okay, we're going to wrap up, and for that we do a last poll question, and then we take 30 seconds from everybody, and then we wrap up. And that last poll question my colleagues are going to put up now, and that's question is, what do you believe the main driver of sustained growth in China over the next decade will be? So if you pick one over the next decade, so again we have a long-term perspective, what will be the main driver of sustained growth? Is it a shift to this consumer services driven economy? Is it getting the debt to GDP ratio down? Is it a greater share of value added in global value supply chains, so China just has a larger share in these global supply chains? Is it environmental sustainable growth? Is it innovation and technological change, which we just discussed? Is it China's adjustment to global trade norms, whatever those exactly will be? Is it market-friendly reforms, which we talked about a little earlier, or is it something else? And that gives all of us a final chance to say which one would you pick and why you agree or deviate with the audience. And again, the audience has quite different opinions, so we'll give it a few more seconds to see which one comes on top or which you are coming on top. So 5, 4, 3, 2, 1. Okay, so the clear winner is the shift to a consumer and services-driven economy. That's about 30% of you are saying that. 22% are saying the shift or more innovation and technological change, which is what we just discussed. And then there's sort of two running in the third and fourth place. It's a greater share of value added in global supply chains and China's adjustment to global trade norms. Leo, let me start with you. Which one would you pick? How do you look at this result?
In terms of the ones that will actually happen and make a difference, it's the first one, the shift to a consumer services economy, and it's entirely driven by urbanization. Initially from counties to small cities, but in reality they all want to move to the big cities. That's what you need to watch. When you see policy changes on that, you'll see growth in China.
And
disagree. I would go with number 2 because you have a situation now where the annual increment in debt service in renminbi terms is greater than the annual increment in GDP in renminbi terms. That locks China into a situation where they can only accelerate capital going into the economy in order to feed zombie debt. That's very unhealthy. They need to let these companies go bankrupt and then they will reshift
Leland.
I agree with two. Also, this is a debt story. Now, I would love to see number one be the case, but I can tell you it's not the case now. It's not even sort of the case. Our data, you can look at it, it's clear as day. There is no transition being done. You saw a little bit of rebalancing back, 2013, 2014. There is no rebalancing in the Chinese economy right now. So that's currently a fantasy. You got to deal with the debt. Some of these other things, they'll move the needle a little bit, but nothing on this list will move the needle enough except the debt.
We take the debt down. Adelman?
Well, I'm going to point out an irony in the selection of the consumer and services-led economy, because usually when economies transform to that as a driving force, they become smoother. But we've already seen sort of, at least in the official numbers, smooth growth, and I don't know what will happen. I think as an economist, though, I will pick technology and innovation as sort of unrealistic as it might seem.
Great comment. Well, may not be that unrealistic. We'll see in 10 years' time, but I'm sure we'll have another China window on before that time, and hopefully some of our panelists on again as well. Leo Austin, thanks a lot. Leland Miller, thank you so much for joining us, and Stevenson Yang, thanks. And of course, Ataman, thank you for joining us today. And actually, next month, when you come back to this, Ataman will be in the moderating seat. We're going to talk about recession. And then the question mark, what recession? So Adnan is going to lead that, look at some of our recession estimates and have some experts around, both from business and from the think tank world, about what is the probability of a recession in 2020 and how will that emerge. Thank you so much for joining us again. We hope to see you again next month. It will actually be the first Wednesday of December this time because of Thanksgiving, so it will be Wednesday, 4th December. Hope to see you again at Window On. We wish you a great day. My name is Bart van Aert, Chief Economist at the Conference Board.